Welcome to another episode of Dukascoin TV's On Finance. I'm Ray, your host, and on today's episode, more on oil prices and what should we expect. Stay tuned. Before now, oil prices used to have a predictable seasonal price swing. You could expect high spikes of oil prices during spring since there is an anticipated demand for summer vacation. And of course, during fall and winter, the price falls. Nowadays, the oil prices are a bit more volatile due to fundamental factors. Many fundamental factors, of course. But these factors have affected the oil prices both negatively and positively. From a technical analysis perspective, take a look at the oil price chart. We can see that the oil price is currently trading in a sideways correction, more like a triangular pattern after a turn from the yearly high. And of course, as the consolidation continues, there is one question that keeps wandering around many investors' minds, and that is, what can we expect from oil prices in the near future? Are we getting a breakout into the upside or the downside? Russia, the third largest producer of petroleum and gas, invaded Ukraine this year. The invasion had an immediate impact on Brent crude oil futures prices. As the conflict continued, the crude oil prices launched at an upward trajectory. The US, Canada, UK, and Australia moved to sanction Russia for the invasion by banning the importation of Russian oil into their countries. While the European Union still relies on Russia oil, they are currently working to place an embargo on it. Sanctions on Russian exports are sustaining high oil prices, which should lead into a broad economic slowdown, negatively impacting oil demand.
Will oil prices continue their rise upwards? Probably in the short term, especially as the Russian conflict continues. Happily, that's going to be, or hopefully that's going to be over pretty soon, although as such, there'll be a restriction on people buying oil from Russia. However, there's always oil from Saudi Arabia, which is a world surplus and can easily put up 2 or 3 million barrels a day and actually bring prices crashing down. And when they get to a certain stage, you probably will see that. So I think down the road, watch out for actually a sharp dive down in oil prices and more as alternative energy gets on stream.
However, the drop in oil demand in China has also reduced the global oil market. The new COVID-19 restrictions in China dragged oil prices further below recent highs. Oil futures sank below $100 a barrel in a whiplash turn as many investors fear another COVID-19 lockdown in China. Therefore, reduction in fuel demand has eased some pressure onto the global crude markets. Since China, one of the largest oil importers out there, they definitely don't need that much of it right now. The U.S. Energy Information Administration's Energy Outlook predicts that by 2025, Brent crude oil's nominal price will be $66 per barrel in a report released in April 2022. The report also predicted that by 2030, world oil demand should drive Brent prices to $89 per barrel and push the price upwards to $132 per barrel by 2040. At the time, it's assumed that the cheap oil sources will have been exhausted, making oil extraction more expensive. The EIA assumes that the global oil demand would flatten out as the utilities rely more on consumers and depend more on natural gas and renewable resources. Even as electric cars grow more popular and the coronavirus pandemic continues, many energy analysts anticipate that oil will maintain the $100 per barrel price. ExxonMobil and other oil corporations are prospering and making their best profits this year.
When I look at oilprice.com, I can see the increase of oil from about 75 to 107, 110 US dollar per barrel. And of course, this benefits many countries who were suffering from low oil pricing, but also it benefits Russia because they now can sell maybe to other places, not to Europe, but to other places for a increased profit. It also, of course, allows investments again to be made. So this is not a bad thing at all.
From a future trader perspective, oil trading has become a little more complicated as oil prices are expected to become volatile and momentum driven. Trading oil can be tricky after spending hours on your analysis trying to find your next big move. And then you become confident, so you place a long order. And as soon as you place a long order, the market comes crashing down. Okay, so you place a short order, and then boom, the market goes to the moon. While some try to stay away from oil trading, others have found a better approach of trading it.
The oil prices will be volatile and also having a lot of momentum. So the problem is, what if you cannot avoid this market? The goal is let the market help you. Solution is we created a basket. It's an index of several metrics and future prices. It contains transport and other sentimental data. Trading will be done by congestion breakout bot. So that goes long of the size you want to buy and that goes short of the size you own. Here's a simplified example. You could buy heating oil sooner or later, valued 100 units. The breakout bot buys the oil future. The oil price doubles 100 to 200 in a short time. The future also doubles 100 to 200 and you made 100. Now you could sell this future at any time before this future expires, call your oil dealer and order your oil. At the same time, you sell the future. That's it.
In conclusion, from the EIA report and expert perspectives, in the short term, we expect the price of oil to keep trading around the $80 to $100 per barrel region. However, in the coming years, we should see an increase in oil and gas prices. And that's all we have for this episode. Thank you for watching. But a reminder, keep yourself up to date with the latest finance news and maybe support your future financial investment decision. I'll see you on the next episode. Thank you.